given the new layer to the internet, which is the internet of value, the layer of ownership, settlement, all of this stuff. Now, unlike the internet, we couldn't own that. We can own this. So the more it gets used, the more the number go up and the more we profit from it. So it's this huge egalitarian democratic way of distributing a huge amount of wealth to a huge number of people. To put it in perspective, this space is a $2.5 trillion space today. By the end of this cycle, it should be $10 to $15 trillion. By 2032, if you continue growing at these kind of rates, you get to $100 trillion. So there's $97.5 trillion of money on the table.
Each bearish cycle weighs primarily on technology stocks because they help shape the future of the markets. Cryptocurrencies are technology-driven, and the next recession will propel them to new heights after the recovery. The technology sector is the one that gains the most after a stock market crash. The cryptocurrency market is the first to benefit from a recession because its technology is new and unexplored. The depreciation of fiat currency, caused by the increase in liquidity needed to repay debts, serves as a catalyst for rising asset prices. This phenomenon, combined with the rapid adoption of cryptocurrencies, like the exponential growth of the internet, could pave the way for a monumental increase in the market capitalization of cryptocurrencies. This space today represents a space of $2.5 trillion. At the end of this cycle, it should be between $10 and $15 trillion. By 2032, if this amount continues to grow at this rate, it will reach $100 trillion. So there is $97.5 trillion on the table. According to Raoul Pal, crypto is an asset that can help anyone become rich if they invest wisely. If you want to be one of them and want to get updated with the latest crypto news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on the liquidity cycle and Ethereum.
The opportunity is so big, and that is just by owning the new internet, essentially. So that's what this is all about. So there is a banana zone, which is the periods of time where it goes bananas. Then we get the corrective periods, and then we repeat this cycle again. Now, will everything repeat perfectly? Will it be identical? No. There's no guarantees come with this. But it's based on the liquidity cycle. It's based on the macro cycle. It's based on interest rates. It's based on a lot of things. If you think of what liquidity is doing, why the central banks and governments are injecting liquidity, it's to be able to fund the debts. We're in the big debt funding cycle this year, which is why the banana zone happens and why the everything code cycle, all of this happens. They have to fund all the debt. And so they inject liquidity into the system. They do it via rate cuts. They do it via the reverse repo. They do it via quantitative easing. They do it by any mechanism they can to roll the debt. And that's Europe, the US, China, Japan, the UK, everybody, right? So they all do the same game. So they're all teeing up. They've been waiting for inflation to come lower, ready to start hitting the accelerator. Liquidity has been rising, which is why the markets have been rising. But it gets to the phase where it has to go up a lot to finance, $10 trillion of stuff that needs to be financed. So that's all to come. And that tends to happen this year and next year.
Everything code is a conceptual framework that suggests that the business cycle repeats itself as liquidity increases to devalue the currency and repay debt rollovers. This cyclical phenomenon has been observed since the 2008 global financial crisis, when central banks reset interest payments and began a new debt maturity cycle every 3 to 4 years. Growth assets such as technology and cryptocurrencies tend to perform exceptionally well during these periods due to their secular adoption trends. Due to its outperformance, the cryptocurrency banana zone is considerably stronger than tech's overly broad summer and fall. The banana zone, where asset prices skyrocket, begins with liquidity growth during the macro summer. This year, we are in the great cycle of debt financing, which is why the banana zone appears and why the everything code cycle. Liquidity has increased, which explains the rise in the markets, but you're getting to the point where you have to step up to fund things worth $10 trillion that need to be funded. It's coming, and it tends to happen this year and next year. After receiving regulatory approval for its Bitcoin ETF earlier this year, Blackrock is now preparing to launch its Ethereum ETF. The SEC filing reveals that the manager has already invested $10 million in the initial purchase of Ether. This upcoming Ethereum ETF launch follows the success of BlackRock's Bitcoin ETF. After just a few months of trading, this exchange-traded fund has reached nearly $20 billion in assets under management. It has become the largest Bitcoin fund in the world. The success of BlackRock's ETFs and the recent SEC approval of several Ethereum ETFs illustrate the gradual adoption of cryptocurrencies by traditional finance. This trend is expected to continue as confidence among institutional investors and regulators strengthens. So people transfer a small portion of their Solana to Ethereum and FOMOing in this trade. But the game starts as soon as the ETF launches, because most people are fully affected. So we are all fully allocated. You have to move from one to the other. People will exchange some of their Bitcoin for Ethereum to do this, but these are institutional flows. What we actually have is a very limited supply, and most Ethereum is simply held and locked, whether staked or not. There is therefore very little free circulation of Ethereum, so it depends on what kind of price action we see. All BlackRock needs to do is add it to wallets. More and more asset managers are looking to offer their clients exposure to digital assets such as Bitcoin and Ethereum ETFs. With its flagship products, BlackRock positions itself as a leader in this emerging asset class. A major shift in sentiment is underway in the cryptocurrency market, linked to the U.S. Securities and Exchange Commission's approval of a rule change allowing Ethereum traded funds. The Bitcoin and Ethereum ETF approvals have generated considerable interest from institutional and retail investors. Following the approval of the Bitcoin ETF, Bitcoin saw substantial price increases and spikes in trading volume, reflecting increased market activity and investor confidence. The approval of Ethereum caused its price to rise, reaching a 12-month high. Trading volumes increased significantly, reflecting strong market enthusiasm.
Yield allows you to build products. You can do all sorts of things with yield. You can take the ETH yield and buy call options to give you upside or guaranteed products. You can create structured products. You can do lots of things. So I think that they've always been interested in ETH, and I've said this for a long time, is the ETH yield is the big game in town. Not because it's high yield, but you can do lots of financial engineering once you've got yield. They also all want to build on the technology, whether it's on a layer 2 or on ETH itself, but this is where they're going to start tokenizing a lot of assets. Nobody gets fired for using Ethereum. So,
Yes.
That's a choice. And most of these people have been building, most of the banks have been building in this space and had teams since 2015, 16, 17. So if you think of the technology they've been using, it's generally ETH. So they understand ETH. ETH is the big one. You don't get fired for it. Your board's not going to tell you off. Why did you use some random thing? But we've now got the flexibility of the layer 2s, which makes it cheaper and easier, depending what level of security they need.
Goldman Sachs will not use the Ethereum ETF. He wants to use Ethereum, just like JP Morgan and everyone else, to tokenize assets and do other things. Performance allows you to create products. You can do all sorts of things with performance. You can take advantage of Ethereum performance and purchase call options for guaranteed or rising products. You can create structured products. You can do a lot of things. No one gets fired for using Ethereum, so it's a choice. And most banks have built in this space and have had teams since 2015, 16, and 17. So if you think about the technology that they use, it's usually Ethereum, so they understand Ethereum. Ethereum is the most important, but now we have the flexibility of layer 2, making them cheaper and simpler, depending on the level of security they need. So this is a very, very important issue for financial markets, much more important than for retail. The Bitcoin and Ethereum ETF approvals are pivotal moments in the crypto industry, each with unique challenges and implications, while the approval of Bitcoin ETF marked the beginning of mainstream acceptance. And the approval of the Ethereum ETF highlights the growing role of digital assets in the financial ecosystem.